G'day, here we are, and I am so excited to be at the start of the latest episode of the ASX Small Cap Wrap with my friend Chris Steptoe, who is the analyst for two funds I invest in, DMX Capital Partners and DMX Australian Shares Fund. That is a mouthful. I guess we can find out why they're called those things. But for now, I'd like to say hello, Chris, and welcome to the show.
Hey, Claude, and thanks for investing. We really appreciate it, and great to be here.
Yeah, no worries. So, first of all, we have to do the normal thing. We're going to put up on the screen for the YouTube videos all the AFSL details. Anything that we do say that is advice under the law is not actually intended as advice, and you should not make decisions based on anything you hear on this podcast. You should definitely get your own advice, and also we have not considered your personal circumstances. My authorised representative number is 1297632, and that's under the AFSL 276544. So, without further ado, Chris, could you please give our listeners an idea of, I guess, how you got to become the analyst for these two lovely little funds that so few people have heard of, but that are doing such a good job for me?
My career, I started off in IT. In fact, I started off as a programmer or a developer. I think they call them software engineers now. I was just a code monkey. While I was in the UK, I saw it was around the .com period. All my colleagues weren't really coding; they all just had they were looking at charts, and so I sort of started to take an interest then, and then kind of got the bug, and started investing personally. And then I guess just networking and connecting with lots of people, including yourself. I think was it Stocks on the Rocks? I went to a conference, and I think I met Steve there, and Steve McCarthy, who's the founder
He's
of DMX.
He's the link between us. So he was one of my. He is, I guess, a mentor of mine, whether he likes it or not, and he taught me a lot. But he himself also is, I guess, a very much a microcap expert, and that's one of the inspiring things for me that has inspired me to just focus on the area where I want to invest and where I have an affinity. So I guess like growth stocks and small cap stocks. And Steve kind of showed me the way with that in terms of he was really interested in looking at microcap stocks that nobody else was looking at. But as I'm sure we are going to discuss on the show today, the problem with microcap stocks is a lot of them have a few warts on them. You know, they're by definition not de-risked. That's why they're so small. And so if you are going to invest at that microcap end of the market, then you do need to have a strong stomach for imperfections, but you can get compensated for that by quite, I guess, low multiples of earnings or potential earnings. Is that fair to say, do you think?
Yeah, I mean, I think that the maximum inefficiency happens at the bottom end of the market, where things can be mispriced, and I mean, there's just a lot more potential to grow when you're already small. We've been going for 10 years. We've compounded 16% per annum. So I think we've proven that the process does work in that space. And we definitely have blow ups, but we sort of manage that with just being careful about position sizes.
Yeah, I mean, you guys, I'm going to avoid the temptation to start name dropping a whole bunch of stocks, but I think suffice it to say that there are certain stocks that I wouldn't touch because they felt so risky, but you guys have invested in and they've done well for the fund. And I guess that is actually part of the reason why I feel comfortable having my superannuation invested with you guys, is because you definitely have a slightly different approach than I do. So that provides a little bit of diversification in my life. But I think that before we get stuck into the stock, in my opinion, low quality stock but cheap stock that we're going to discuss today, I wanted to discuss a stock that we agree on, because just today you've probably listened to it. I certainly just came from it. We just had the AGM of Energy One, which is one of the companies that I have already talked about on this very podcast. And on top of that, I've been writing about it for years. I think I was actually in it before you guys, which is a bit special for me. And although Chris doesn't look convinced to that by that one, but I was.
Oh no! I remember looking at it at under $1, and there just wasn't enough liquidity for us to buy it. So we definitely were looking at it, but yeah, we entered.
Okay, you're right. You're looking at it, but I got it. I actually bought it because, like, I don't worry about.
Yeah, that's the advantage of being. It's the advantage of retail, you know.
Yeah. Yeah. No. Okay. No, I wasn't poor, but I had some money to put in Energy One. That was like $1.10. Blah blah blah. A whole bunch of stuff happened. I finally recommended the stock at $5. By then, you guys were definitely in it, and yeah, we had some tough times, and now we've got some good times. And everybody, like, you should have seen the AGM physically today. Like, I don't think they've had that many people in the AGM before. Like, it was a fairly packed room. Like, I was clearly the odd one out in my checkered shirt and silly hat. Every single guy there was like, except for Steve, was like, you know, how he has his own style. But most of them, they all looked exactly the same. They were all like working for a fund, blah blah blah. There was one guy that was just there for the snacks. He didn't know what the company did. But anyway, I guess that means we've made it to the big league.
It's definitely moved into the A League. You know, it's the market cap broken through 100 million. It's the liquidity, so it allows funds to get in and get out because they like to pivot.
Well, let's point a put there because I've said this on Ausbiz, which I put on the YouTube channel as well. But basically, the big thing that happened is in the H1 results, Wilson Asset Management just bought up heaps of liquidity. And now after the full year results, where finally all of the quantitative scans are showing up, Energy One as a profitable growing software company, Wilson Asset Management has released a lot of that liquidity to the other fundies for a quick profit for themselves. But I guess the real discussion is, what do you think? I have my opinion, but do you reckon that as a general rule, the mainstream small cap and mid cap funds, do you reckon they underweight this stock or overweight this stock, Energy One?
Well, I think it's just been discovered and they're slowly moving onto it. So I think, yeah, I mean,
they're trying to get not underweight it, but they are. Some of them
I feel as if they have to own it now.
Yeah, exactly. They feel like they have to, and this is why I told you guys you're underweight it, even though you had a good position to it, because all of them want to get it now. And the ones that don't have it, they're worried. And as soon as it comes down, they potentially buy because clearly it's like basically a decent quality software stock. And there's like 10 of them on the whole ASX. And this is one of the smallest ones. And we're losing them all the time. We've lost Altium and we're losing RPM Global, which we're going to talk about at the end of the show if we have time. But ultimately, with Energy One, I think my feel from the AGM is like, for example, I saw an analyst from Lakehouse Capital there, and those guys, they're pretty good, but they're more small medium, I'd say. You know, they're not exactly tiny cap. They're definitely not micro cap guys. Like one of Lakehouse Capital's successors is like me, Pro Medicus. They've owned that, so they're more of your quality small mid cap kind of guys, and one of those guys was there at the AGM. I don't know if they own it or not, but like all I'm saying is like there's clearly a lot of fund analysts interested. The brokers are going to be all over it. You know, I was talking with my friend, and it's like he probably quite rightly thinks that now the brokers will all be whispering in their ear, "Oh, you can raise capital to do an acquisition. You can raise capital to do an acquisition." I think where I've landed with Energy One is I don't want them to do an acquisition now, and I definitely don't want them to go to the USA because their new CEO is going to be a French guy who seems lovely and great, but he should definitely focus on Europe because America's hard and risky, and there's so much room to grow in Europe. What do you think of that proposition?
Yeah, I think you're right that it's risky, but I do think they're going to go to the US.
Nah, don't give up, mate. We got to fight it. Like they were going to go. You remember they were going to let the company be taken over at $5.80 or something. You got to fight it. You got to push it back.
Yeah. I mean, yeah, I think the valuation. You mentioned the 585, and there's directors selling at these levels, and they were prepared 2 years ago to sell at 585. So I think that they might raise capital because the equity is so cheap at the moment to,
What to
to, to make
essentially,
that acquisition.
yeah. I know you mean it's cheap. The equity, the selling the shares are expensive, so therefore the acquisition's cheaper for them. I get what you're saying, but I'm still against it because this is the problem, right? You get the guys that come in early, and you're so used to finding companies like, I guess, some Indian ATM operator or something. And those kind of companies, you definitely got to sell it. You definitely got to sell some, right? Because they're not multi-year compounders. They're not awesome, high-quality stocks. But Energy One does have that potential. So you don't want to get them confused. Like, this is in a whole new league. This could be, Tribeca, or I want to sell to Hyperion, man. Like, that's who I want to sell to. Just an absolute superannuation fire hose of money. That's who I want to sell to. So yes, I do agree. Energy One is in the take profit zone, and I think it could go down from here. And I'm not buying, but it can. These things can go crazy, like when they're high quality. Anyway, with that rant out of the way, we should definitely move on to the substantive discussion of the day. And I'm excited about this because this is not only have we had readers request this, we had a YouTube commenter request it, and so I'm very happy to say that the stock you're going to tell us about today is Austin Engineering, ANG. And so please take us away by telling us, what does Austin Engineering do?
Cool. Yeah, so they primarily they make trays for these big trucks that roam around mining sites. So, say for example for Rio, and also the buckets to pick up all the dirt and chuck it into those trays. So they're in the aftermarket. So what happens with these trucks? They last for multiple years, 10 to 20 years. Whereas the trays, they get worn out and they need to be replaced, and that's where they step in and develop lightweight trays. So they're, because of the diesel is so expensive, it's important to have lightweight trays. They actually use the steel made by an Aussie company called Biz Alloy, um, which specialise in
I actually owned
trays.
shares in that for a while, and I wish I'd held on to them because I think I've done quite well. Sidetrack finished. Please continue.
So okay, yeah. So it's 185 million market cap today. It's just under 30 cents, but it's quite a substantial business. They've got $400 million in revenue forecast for FY26, and around 40 million EBIT. So it's profitable as well.
Well, that's an important point, and I think we're about to talk more about that. But how reliable do you think their forecasts are? And like, is it kind of one of those businesses where it's kind of hard for them to forecast sales that far out?
Oh, look, they've got an order book, so I think they have about 3 to 6 months sort of visibility to their sales. So it's not. I mean, they can. I think they could confidently sort of predict their first half result. Less so with their full year result, but yeah, it's not a recurring revenue business, but it does. They do need to replace them every 5 or 6 years, so they can kind of predict what their clients will need, but they can defer. They can defer the replacement, so it's not guaranteed that they'll. Yeah, there can be lumpiness in those earnings, and we saw that after the sort of mining boom in 2013. There was a lot of deferrals of people just putting off replacing their trays.
Right. I think we can find some common ground, which is that it's not like a super high quality business, but that doesn't mean it's a bad business. Like, what's the pitch? Why does DMX Australian Shares Fund, which is one of the funds you're an analyst for, they own this stock that, and I also, I guess, like, as an investor in that fund, have some interest in it, but wouldn't choose it myself. So tell me, what's the pitch? Like, what's the thesis for owning it? Why do you think the share price will go up?
Well, I think at a really interesting stage. It's in the dog box. So it was at 65 cents about a year ago, I think. It's halved. So
Mm.
I think it's important to understand why it's halved, and
Yep.
if you can understand the reasons why it's halved, and
So tell us, what are the
um,
reasons? Why did it halve? Why did it halve?
well, so they had to restate their FY24 earnings. So what happened was they overstated their FY24 earnings and then raised their FY25 earnings, which is just messy. So that's one reason I think. They also they've had issues. So they've won this contract with a major OEM that's got like an insect, a caterpillar maybe, and it's a really big deal to get this contract. But I think they've overcommitted, and their Chile facility is supposed to be delivering them, but hasn't. And they've taken a bath on the deal, so it's impacted their earnings. Um, and they've had to they've got to fix it basically. So I don't think
So basically,
it's
what we're
fixed.
talking about is they've agreed to sell trays to someone for a certain price, but now they're like can't, and it's costing them too much, and they're losing money on
That's
that deal.
I wouldn't say they're losing money, but they're not making as much as they should have.
Yeah, right. And like, how do they fix this situation?
So they've got um, manufacturing around the world. So they're in Australia, the US, Chile, and they've got a Indonesian facility, which is quite low cost. And so they were supposed to build them in Chile. Now they're going to try and build them in Indonesia instead, and that will hopefully fix the cost issue. They are also having management change in Chile, so they're sending the Americans down to Chile to get things sorted there. So yeah, we don't yet know if they'll be successful with that, but
It's basically
I think
this.
that's one of the reasons.
Yeah, that makes sense. Look, I've loved South America and have been there many times, but like my basic instinct is I would not want to do business there. Do we have any real insight of why the Chilean operations aren't performing?
I think it's people. Well, that's certainly the feedback we've had from management is that yeah, they're perhaps not as committed and hardworking, and yeah, the American operation has been very successful.
So I guess my second follow up question then is, let's say that the Chilean operations are just never going to be as good as they want them to be. Where does that leave the company? Like, does it still justify its share price now without fixing up the Chilean operations, or is that really make or break for them?
Oh, I don't think it is at all. I mean, the Chilean operation didn't contribute anything last year, and yeah, they still did a 40 million adjusted impact. Now that's another reason why it's in
Okay,
the
you got to
dog box
walk
is
us
that
through all of the ugly stuff here. Why is it adjusted? What's the story?
uh, yeah, so they did a lot of adjustments um, to the profit. One of them was they had a conference that they attended, which occurs once every 4 years or something, but they backed it out. I think that's just BAU operations. But there's a whole heap of things which we thought were not really one off. But I guess even with those one offs, it's still not overpriced.
Yeah. So, do you think that it is reasonable to say that this company can earn about more than 4 cents per share per year? So, in 2024, restated they did around 4 cents in diluted, or a bit under. In 2025, they did 4 cents earnings per share, um, just statutory. 4.2 cents. Do you think that like that four, like if we just say, all right, these guys are going to keep making 4 cents per share, do you think that would be a reasonable thing and a reasonable assertion?
Yeah, I think 4 cents in 26 is reasonable, and yeah, we'd be disappointed if they didn't maintain that or at least and grow it.
Yeah.
I think there's upsides that we can talk about as
Yeah, so
well.
what are the upsides? Let's take us there then. Because basically the argument is, yes, it's got warts, it's cheap. We think it can make at least 4 cents per share. So I guess the crux is, and what people will be interested in is, what's the upside from that? How might they grow that amount of earnings?
Yeah, so I mean they've been growing the last few years and growing their profits. So there's definitely a growth pathway, sort of organic. This deal they've done with the OEM, which they're having problems in Chile, if they can be successful in that, and then make it a sort of not just a South American arrangement, if they can do it globally and produce these trays for that OEM globally, it'll increase their sales significantly and their profits. But also, when the customer goes to renew, they've already got that relationship with the customer. So it's a great way of increasing their distribution. So that I think that could be a real game changer if it comes off. But all it needs is a re-rate, to be honest, off that 4 cents for it to be a successful investment.
I'll put the chart up for people watching the videos, but essentially we're talking about a stock right now that's trading on about 30 cents per share. It's like way under 10 PE, price to earnings ratio, if they can maintain that 4 cents. So although we don't often hear about value investing ideas in the media, I mean, hypothetically, you could buy shares and they just keep on making reasonably high earnings. Eventually that should strengthen their balance sheet. Eventually that should allow them to pay out like dividends and stuff like that. But actually, speaking of that, what are your thoughts on dividends with this company?
So they do pay a dividend. It's between 2 to 3% fully franked, I think. So they've got very little debt. They should pay off the rest of their debt this year, so they'll have plenty of free cash flow. They've got a buyback on, so I'd hope that they'd be buying back at these levels rather than paying extra dividends.
Yeah, right. So I think probably the dividend provides some proof of the growth thing, right? Because the dividend did increase slightly despite all the supposed bad news or whatever. And so the trailing dividend is 1.5 cents per share, fully franked. So gosh, what does that leave us at? This is really a high dividend yield because it's 5%. But then if you gross it up for franking credits, it takes you to about 7%. So compared to your bank account that's getting 4% or something, it is a reasonably high dividend yield. And so ultimately, you don't really need that much capital gains to make this a decent investment. Like if you even made 5-10% a year on capital gains, then you're doing pretty well. But I mean, I guess the weakness in this kind of thesis, or the reason that I prefer multi-year compounders over this kind of value play, is that ultimately, at some point, you get your returns. It trades at a more reasonable price. I mean, is this not just one of those situations where the thesis is you're buying cheap and then you're selling at a reasonable price? Is that fair to say?
I think possibly, but if they are successful in the OEM contract, then they'd have a long runway. I'd be even their current growth rate. I don't. I think you can certainly don't. You don't have to think about it as a cigar butt.
Yeah, it is better than a cigar butt because you're paying sort of cigar butt prices for a company that, well, you think could actually sort of improve its earnings over the next few years rather than have them decline.
Well, yeah, absolutely. Yeah, I mean, so at DMX we invest in growing, profitable companies. That's what we like. And under the radar,
It
yeah,
ticks all those
it's,
boxes for sure. You guys are definitely
it's
remain on your strategy. Like, Wins, yes, they happen. Losses, they do happen too. But you remain on your strategy. I definitely give you that. And also, it's a reasonable strategy, right? Not that different from mine. I guess the thing that I like butt up against this is I have a huge sensitivity to not performing as expected, or, what I consider bad management. So, like, for example, I'm just going to reframe this, and I'm not saying I'm right and I'm not saying you're wrong, but what I am saying is another way to look at this contract that's not performing is that they suck at making contracts. Like, somebody sat down at the negotiating table and did a bad job. And as a result, they've now got this contract that's like not as profitable as it should be. So for me, I'm always looking for that long-term advantage. Why are these guys better forever? And so for the stuff that I'm looking for, it has to be low capital intensive. I mean, that automatically throws out someone that like makes physical things. Like half most of my portfolio is just like on the computer, like their products on the computer, like, or it's a brand, it's in the mind, it's, all of these ethereal things is where you can get huge return on invested capital. Whereas when you actually have to make stuff that actually does something in the real world, it's hard to be as profitable because you need to have the capital to put in the first place. Now, I'm not saying you can't make money. Like, if you've ever given us the example where you can make money, it's when the stock has potential to growth and it's priced for zero growth.
Yeah. Look, I think if it does provide a barrier of entry, having to have manufacturing facilities, know-how. I mean, there's definitely, just ask the Chinese. I mean, they've got such a massive advantage.
That's exactly how you do it. It's a barrier to entry. Yeah, well, our business is so terrible. Why would you ever try and compete with us? I agree.
I mean, software companies, you could get, is it Claude that can write code for you now?
Yeah, don't say that. Oh, I thought I was the only Claude. No, you're right. Yeah, look, and also, of course, it's a completely different. It's actually just good to. It's good to know that there's a diversity. You guys do own software companies as well. It's not like I'm trying to push you into this corner where you like only own this, manufacturing companies. But I guess because we hardly ever talk about these kind of companies on this channel, I definitely, because it's like, even when I do invest in companies that make stuff, I'm always looking for that razor plus blade model. I like love the idea of just like predictable revenue. And the reason I love it is because I know that the market loves it as well. And if you have something the market loves, then you have this sort of self-fulfilling prophecy where as more people just find out about it, then more people want to buy shares. And it sort of it gives you that longer run of it. But having said that, and notwithstanding the fact that there's basically no chance I'm going to buy shares in this stock myself, I definitely appreciate the thesis. Like, I see it. Like, it's just, the PE ratio is just too low if they're growing. Like, it doesn't make sense. Eventually, they will strengthen the balance sheet. Eventually, they can buy back shares, keep paying a dividend. Like, it's all of, eventually, if the earnings are there, the company should be able to force up the share price. And that is exactly, why I actually, even though I'm not going to buy shares myself, I actually do think that there's a good chance that you'll get a good return out of it.
I mean, I don't actually see them too differently from ABV, advanced braking. We've
Cool.
got,
All right. Yes, I love it. So I love Chris has now taken the initiative here, and he's brought up a stock that he knows I like, which I've never talked about on the podcast, I don't think, before. And it is Advanced Braking Technologies, which I own shares in, full disclosure. And what they do is quite similar in some ways because it's the same kind of customer base, really, isn't it?
yeah,
As the mining companies. And it's so similar because Austin Engineering is doing the trays for these trucks, whereas Advanced Braking is doing the little brake, the special enclosed brakes that really are what you need on a mining site, because a mining site has so much dust, and underground mining, you also don't want to put out fumes. So you need these enclosed brakes to ensure, and you need fail-safe brakes to ensure that if the driver passes out or if they make a mistake or something, there's some way to stop this truck from crashing really quickly. That can be automatic, and that can also be just a button that they can slam really quickly. And so the differentiating point for me is really that with advanced braking, you get the sale of the brake, but then you also get every year maintenance revenue for 4 years. And then hypothetically after that, yeah, they replace the brake again, and then there's another 4 years. So that's the difference. So
Yeah.
that's why I'm claiming an excuse here and difference of why the one I like is good and the one you like is not so good.
Yeah, we own ABV as well, so I agree. I just
There's actually a lot of agreeing here, but I need to make the disagreement, so that we can have the debate. And the difference is that, yeah, basically there's more of a recurring revenue element with advanced braking than there is with Austin Engineering.
I think there's probably a bit more IP as well, and probably a little bit less competition. I think advanced braking, there's really only one other competitor, whereas Austin have they've got quite a few competitors and some quite strong competitors as well.
But then, of course, the other difference, which I have to bring up in your favor since you've generously made a point in mine, is that the PE ratio of advanced braking is significantly higher, more than double the PE ratio of Austin Engineering.
Yeah, I think ABV might be on 14 or 15 times, whereas
Or even if you use underlying, it's definitely
Austin's probably on 5 or 6.
Yeah, it's definitely a lot. Like you're paying up for ABV, but I mean that's my style. I much prefer pay up for that like slightly higher quality company. I'll pay a higher multiple, and yeah, both approaches can work though. It's not like there's one way to win on the stock market. So, with that in mind, and because I want to like keep time for our last company, I think that covers off on Austin Engineering pretty well. I think that our readers should be happy that we've given the good pitch for that. But any final thoughts on it? Like, for example, could you give us some thoughts on management? Like, who are we trusting here to guide us through it? And
Yeah, look, I think the story here, there's quite a history to it. And if you look into it, it was $4 at one stage, and then they got into a bit of trouble. We had to raise capital. In 2021, John Singleton joined as CEO and basically turned it around. And he resigned this year, and Cy Van Dyke has taken over. We've had dealings with him. We were invested in Swick Mining, and then it turned into DD DDT. I can't remember the
DD1,
code
was it
anymore.
DD1? I know what you're talking about now.
DD1, yeah, that's right. Yeah, so he kind of did a really good job on that. So, and we've spoken to him recently, and that's part of the reason we're talking about today, because I've had a recent catch up with him. So yeah, he seems very like he's a hard nosed South African, and yeah, he seems to be very proactive about what's going on in South America. So yeah, I actually came away feeling more confident. He's more telling you what the issues are, as opposed to the previous CEO who was basically promoting the company.
You've, you've
So
finally
yeah, I
hit on
think
the point that's really starting to convince me here. Because DD1 from memory, so Chris and I have both been, in the markets for a long time. So I'm sorry for the newcomers who we're talking about ancient history here. But DD1 got taken over into something, right?
so. Swick got bought by DD1, and then DD1 got bought by Parenti.
So it's like these mining service companies, like bigger ones swallowing the smaller ones. So you buy the smaller one and you get swallowed eventually, basically, is kind of the story here. But if he knows that, then like what he's doing hypothetically is taking a company that's like not the easiest company and not the best company, but he's trying to make it operate well and look good, and then someone else wants to buy it. So that's kind of good, really, if he's got experience getting the not so good company taken over by a bigger company after he made it look better. That's kind of good, because that is like a repeatable framework to me, which is the perfect segue into the final stock we're going to talk about on the show today, which is RPM Global, which is another situation where you've had this fantastic operator, in this case, the CEO, Richard Matthews. He came in, 2013, 2014, somewhere about that, about 10 years ago now. Richard Matthews came in to RPM Global, in which I own shares, by the way, and he bought shares himself on market, and he took over this company that was like coal something testing and a lot of like advisory work and like a software business that was quite small. And he relentlessly grew the software business. I've been following this for years. I recommended it to Motley Fool Hidden Gems at 40 cents in 2016, I think. And basically the whole thesis just played out like what he kind of seemed to imply from the beginning he was planning to do: build out this software company, make it look really good, sell it for a premium. Now they've got a takeover offer. Now, I want you to tell your story of the fund and RPM Global as well. How did you guys get into it? What's the opportunity you saw? And I also want to hear your opinion on like what to do right now, because I'll say myself personally, this is what we've done at A Rich Life. We've sold half the position already before the takeover gets done. And I've followed that after first I said the sell recommendation, then people get to sell. Then a couple of days later, I sell myself. So we've done that. I've halved my position. I got the rest there thinking, yeah, this is almost certainly going to go through now. But at the same time, there's hardly any upside, right? Because it's like share price at the time of recording is $4.86. And the takeover price is $5, is it not?
I think it is, yeah.
Yeah, so where did the DMX... So this would again be the DMX Australian Shares Fund, the bigger fund, like the fund that invests in bigger companies. What was your thinking about RPM Global, and what are you thinking about it now? Like, how did you get into it in the first place? Because it's obviously a very different thesis to Austin Engineering.
I think we first invested in 2021. And we've actually traded it a bit.
Okay, Chris, my question is this. With RPM Global, is that a situation, like I know that you guys being more value investors, you're more likely to take profits, etc. Is RPM Global a situation where perhaps you should have just held on? Is this a higher quality company where I could start trying to convert you to my way of thinking, which is when they're good, decent quality companies, you just hold on?
Yeah, okay, yes. We probably did sell a little bit too early on RPM. We owned it. We did quite well out of it, but not as well as we could have. Yeah.
Yeah. Okay. So this is the
So
theme.
I think we sold in $3 or something like that.
So this is a theme that I'm trying to get across over. It's like the overarching theme of the podcast is that when you have a good quality company, it's better to at least hold on to some of those shares.
Yeah, I agree. I guess when you run a fund, you've got to consider position sizing. You've got to consider other uses. Can you find better opportunities? But yeah, I think forgetting about it and putting it in the bottom drawer can sometimes work. But I think.
But the thing is, I don't blame you guys for that, because I'm saying whatever style you do as you're investing, I think the safest and easiest thing to do is just remain consistent with that style. So I can understand why you guys would sell, because overall with your style, like it is very valuation sensitive. So it makes sense to, when your valuation assessment is saying it's too high, to sell, because basically, except for those very few companies that are really high quality, you don't want to like be holding on to stuff that becomes really expensive. But at the same time, I'm super sensitive to the idea that certain companies you should just hold on to, because my entire game is trying to find those companies. And part of that comes from what I do, right? Because with a fund, you're trying to do your process that you've said to investors that you're going to do. Whereas with me, I know that my main clientele are just people that are doing it themselves. And the best thing that I can do for them is find a set it and forget stock. Because the reality is, because of the vicissitudes of people's lives, is they might be interested in investing for 6 months or a year, and then they have a kid or buy a house or whatever it is, and it falls off the radar for them. So we face this problem is that, like, yeah, a certain number of our people will subscribe, buy some stocks that we like, and then their subscription will lapse, or their subscription may continue, but they just stop reading the emails. So for that reason, I have this huge bias to looking for the companies where if someone buys it and forgets about it, they'll be okay, essentially. So it's not necessarily that my way is always right, but at the same time, the little needling thing that I always love to give you guys is like, oh, this is a high quality one. You don't have to sell it.
Yeah, look, I think I think one of the big lessons or takeaways from RPM is to back the jockey. I think Richard Matthews had done that a similar thing previously, and he said he was going to do it, and yeah, his execution was very good all the way through.
But it sounds like this operator that's the CEO of Austin Engineering, you think he is possibly a good operator who can execute well as well.
Yeah, I do think he's a good operator. I mean, um, but sometimes businesses are hard.
Look, there you go, everybody, ladies and gentlemen. We have gotten the first genuine value investing, style idea here on the ASX Small Cap Wrap. And isn't it like nice full circle moment for me? Because like that's how I started as a value investor. And then I realized that just a small lobotomy and I could probably make more money more easily. But I do still think that at the end of the day, you do need to have valuation considerations in any kind of investing, whether you're aiming for long-term growth or whether you're aiming for like a re-rate based on something being temporarily too cheap. So I really love that we're starting to get like introduce more styles of investing and different ideas. Like the last episode, we were all about the growth stocks. We're talking about loss making stuff, and the reality of the situation is in a market that is a bull market or a risk on market is probably a better way to describe it. Generally speaking, Austin Engineering is the exact kind of stuff that gets forgotten, and the more exciting growth stuff goes up. But then when you have a market that's risk off, people are suddenly look at, well, show me the money. And then they are more interested, and often at that stage, more value stuff outperforms. So even though I don't own this particular stock, I still do have some, and we'll get into them some other day, I guess, because we're running out of time now. But I actually have a couple of value investing stocks in my portfolio that I like sort of rarely write about and stuff, but keep for similar reasons, big, heavy industrial, asset heavy kind of stuff. And I think it's healthy to like keep our brains functioning and also emotionally. I own, almost all my money's in these like high growth software, kind of high quality businesses. But gosh, the emotional toll when those things are out of favor is huge. And it can mean a lot to have a little diversity in the portfolio.
Yeah, look, I think you've got to find your own investing style of what you feel comfortable. How do you sleep at night? And yeah, I guess, well, for me personally, knowing that I've got a valuation that will support the share price, yeah, that's that's the way I like to invest, and we do it at DMX. But it's not the only way to invest. There's lots of ways to invest, and yeah, it's great to explore different ways.
All right. Well, that is a perfect way to end it. You've got to find your own investing style. I couldn't agree more. I worked so hard to find disagreement this whole thing. We're going to end on massive agreement. Everyone needs to find their own investment side. Each person out there who's on this journey, who's trying to figure out how can they make money on the stock market, you have your own knowledge of certain industries. You have your own knowledge of yourself. So compensate for your weaknesses, lean into your strengths, and that will be the way that you can improve as an investor. And gosh, it gets easier with. My God, it's so much easier with 5 years experience than it is with zero, and it's easier with 10 years experience than five. And I'm probably I'm not even at 15 quite yet. So I'm sure others, maybe yourself, can tell me what it's like then. But the point is, thank you so much for coming on the show. Chris, any final thoughts to share with the audience?
No, it's been a pleasure, Claude, and yeah, thanks for having me on. It's been fun.
Right. Well, I've got some final thoughts. Before I launch into the disclaimer stuff, I just want to say DMX Capital, DMX Australian Shares Fund, and DMX Capital Partners from DMX Asset Management, they put out some of the best fund reports you're going to find in any small cap fund world. They like really give you so much more information about what they're thinking or what they're doing than almost anyone else. So if you are in the small cap space, it's a no-brainer to sign up to their free monthly fund newsletters. I can't believe that how good it is, basically, because even me, sometimes going to again resist the name dropping of stocks, but there's been multiple times when the reason that I have ultimately bought a stock myself has been because you guys have first drawn it to my attention. So, like, thank you so much for what you do. Like, obviously, I invest in your funds, but also you guys are actually putting out a lot of good stuff to just anyone who's interested, which is really awesome. So, thank you so much for that. You're too well kept secret. I'm so happy you came on the show. Final point here is, remember, we could have made mistakes in this podcast. Secondly, the funds Chris worked for are going to have positions and may, trade or whatever. They may in the future buy or sell their positions. They obviously have A&G engineering. I think we mentioned advanced braking as well. I own advanced braking. I own EOL. I own RUL.
Yeah, we own EOL as well.
Yeah, exactly. So there's your disclosures, guys. Take it into account. Natural biases, we can't always escape them, but you need to also know where our interests lie. So thank you so much for listening, everyone. Final thought, of course, is you guys know I'm doing this because the website can't survive without the YouTube and the podcast. So please do leave those reviews, like it. If you're on YouTube, that's the best one for us. Please subscribe, but also hit that little bell signal to get alerted when we post something. Because, with your help, we can survive another couple of years, even despite the onslaught of AI muck that is everywhere now and ruining the internet. And guess what? I think if we can survive this moment in time, maybe on the other side of it, there's going to be so much AI muck that people will start valuing like real opinions from real humans again. So that's my final pitch. Thank you so much, Chris. Thank you so much for listening, and have a great day, everybody.
Cheers, Claude.